So I'll just quickly talk you through some of the services that we provide before I hand over to my colleague Dipankar from the Indian office. So we provide a whole range of services that you would expect from a firm such as ours, starting with audit and assurance. We do statutory audits. We act as external auditors for global clients and also for regional industry leaders. We have huge expertise. We use state-of-the-art software with AI built in to provide deep insights to all of our audit clients. We can also do audit of donor-funded projects and special purpose audits, as well as training, such as this one. We provide training, IFRS, and any other technical areas for audit and for compliance with regulations relating to accounting standards. And then in our taxation services, we provide a full range of tax compliance services, filing your tax returns. We provide a full range of tax advisory services. We do things like health checks, tax audits. We can provide tax opinions. We also fight your cases against revenue authorities globally, and we have a good track record of providing the right advice and also of reducing your tax liability, sometimes completely reversing the decisions against you. We provide transfer pricing services. We also provide services on employment and expatriate taxation, and we can do all of your international corporate tax planning for you. And then we have a outsourcing center, which provides a whole range of outsourcing services. So if there's any services that you think, you don't want to be doing because you want to focus on your own core business, you can outsource that to BDO. So we're talking about things like accounting and bookkeeping, compilation of your annual reports, your statutory reports, your management accounting. We also provide financial management agent services, as well as fiscal management services. We can operate your bank accounts for you. You can outsource your entire payroll to us. We also provide a whole range of company secretarial services, so we can form your companies for you. We can act as your company secretaries, come to all your board meetings, and so on and so forth. We also provide legal services as well as a whole range of admin and accounting services. And then the department that I head, which is the advisory services department. Here we do internal audit and risk management services. Again, we can act as your outsourced internal auditors, which means, you don't need to have a full internal audit team. You can actually ask BDO to come in. We will typically come in 4 times a year, once every quarter, and we will cover your entire audit cycle, So we look at all of your departments, all of your policies, and we can usually do it at about 30% of the cost that you would incur if you had a full-time department yourselves. And we provide a global standard. So, you improve your standard and you actually reduce your costs by nearly 70%. So that's the promise in internal audit. We can also provide a whole range of management consultancy services. I also head the corporate recovery and the business turnaround services division. So if there are any areas or divisions or products that are not profitable and you want us to come and have a look at how to turn around that business, what your options are, we'd be happy to come and look at that as well. And then we provide a whole range of transactions, advisory services and corporate finance services, which is basically deal advisory. And in fact, right now, BDO has the highest number of deals globally compared to any other company. So we're actually number 1 in this area globally, not in terms of value, but just in terms of the number of deals that we do with our clients. And this speaks volumes about our staff, because companies won't come to you, with their deals. I mean, deals are really the make or break of businesses when they want to expand or they want to go into new areas. You really need somebody that you can trust to ensure that that deal happens, and it happens in favorable terms, and it's also secures your long-term viability. And therefore, this is an area that we can partner with you. And then we have a forensic investigations department where we can deal with fraud. We have specialized AI forensic software to enable you to actually do continuous auditing, continuous programs. And then we also have a technology advisory division for all of your IT needs. We can provide business intelligence services such as data privacy, digital intelligence as well. And we also provide a full range of sustainability and ESG advisory services. And this training is part of that service. So, yeah, please do contact BDO wherever you operate, and we'll be very happy to come and help you. Usually, our first consultation is free. So, pick up the phone, call us whenever you need any services, and we'd be more than happy to come and have a chat with you in any of the areas where you think we may be of assistance. And with that, what I'd like to do is to hand over to my colleague, Dipankar. Dipankar, if you can please take us through what the agenda is for today. Thank you.
Yeah, thank you so much. And thank you, Meha, for anchoring this, and Zahir for the introduction. So I think this is a part of a webinar series on ESG, which has started from April onwards. In the first version, we had the basics of ESG. Then we went on to prioritization of ESG topics, which is assessment of materiality and stakeholder engagement and so on. And today, we are talking more about creating an ESG roadmap, what it means, what it takes to create a roadmap for an organization. So that is where we are, and we intend to have one more and many more perhaps later, which will cover topics specialized and of interest of many of you. So let's go further, Meha. It's really a pleasure for me to be able to share with you all participants our experience, which comes from the ESG support that we have been providing to our clients over decades. I would say that I am kind of privileged to be able to see how the topic of ESG sustainability became important over the years, and how companies, organizations are now really realizing the business benefits out of implementing sound ESG practices. And as I always say, there are two facets of ESG or sustainability. One, is that regulatory requirements around these have been more and more prominent all over the world in the past years. Regulations with respect to, for example, ESG performance as well as disclosure has always been constantly been tightening, necessitating adoption of ESG policy, governance, procedures, and reporting for the companies and organizations. On the other hand, in the past years, we have seen that ESG has its own business value. For any business, the stakeholders, be it the providers of capital, or the investors, or be it customers, suppliers, local communities, or even employees, the expectation of everyone is that businesses should perform responsibly, so that effect on the external environment is kind of minimal. And additionally, the investor or the capital providers would also like to see that businesses are resilient with respect to external changes that keeps on happening, with respect to global climate change issues, for example, cross-border regulations, energy and resource security point of view, and so on and so forth. So the expectation is the business should be kind of future-proof. Therefore, so both these imperatives, one which is the regulatory requirement and also one from the business perspective, both actually equally motivate businesses to prioritize ESG or sustainability practices within their business organizations. Now, with that backdrop, on this page, what we intended to show, Meha, you can just go back for a minute. Yeah, on this page, what we intended to show you is a glimpse of our services we provide to support our clients. Those who have attended our earlier webinars are already maybe familiar, so I would not get into details. But I wanted to point out one thing, that depending on ESG or sustainability related maturity of an organization, the requirement of support keeps changing. And our solutions are actually accordingly designed to support organizations who are, kind of starting the journey in terms of ESG or sustainability, and also for those who are significantly advanced. And the other thing is that our solutions are substantially what we call sector agnostic. Over the past decades, we have had the opportunity to support organizations from uh, various industry sectors. Our, the basic domain knowledge together with our sectoral expertise, that is what we kind of leverage on. And some of our solutions are related to advisory in nature.
Sorry, Dipankar, you're on mute.
Yes, right. May I still see the previous slide? Did you? Yeah, I think we're good to go. Yeah. Right. I will quickly do a kind of recap of what we kind of heard in our previous, webinars when we covered a few aspects. In the first in the series, which happened in the month of April, we covered, basically the basics. We introduced the concept of what you call environmental, social, and economic performance, and how, sound governance act kind of as a bedrock on which these pillars stand. And we also discussed how ESG helps in creating levers for value creation, such as growth, cost reduction, efficiency, and so on, and touched upon the basic steps of creating, ESG framework. So that we covered. And then in the next one, we can move on. In the second webinar, we tried to understand the concept of what we call materiality. Why materiality is important? What happens is, as for ESG or sustainability, there are hundreds of topics which are important in terms of for any organization. But depending on your organization's business context, all may not be equally important or relevant. Therefore, for any organization, it is important to understand what are those material ESG topics, and we covered how to do it and all those things in details in our previous one. With that, I think let us move on, Meha. Yeah. With that, what happened, the imperative of an ESG strategy becomes more and more clear. But even with the need established, it is kind of inconspicuous by its absence. Even today, and this is as per a recent survey, what you see, 38% of the companies do not have an ESG strategy globally. 50%, B2B respondents, who participated in this survey believe that for most companies, ESG is not just it's just a, marketing exercise, which actually is not so. There are numerous, business benefits out of it. So these are the kind of things we are, hearing when in the misconceptions or whatever we are hearing when we are talking about ESG. And the risk of such, absence, need not be overemphasized. We can see that the risks of, not having an ESG strategy on regulatory front, on financial front, operational front, reputation front, and innovation front, we all kind of lag if we do not have a proper ESG, implementation and ESG strategy in place. So let us move forward, Meha. Here are some examples, of risks related to ESG that are impacting the business. I will not talk about all of them in details, but just to give a few examples, in Colombia, for example, in South America, a multinational investment firm took controlling stake in an infra project. But they went ahead with selecting partners, contractors, and they were about to start the implementation. But at that very moment, at the last moment, what happened was regulators found that some serious environmental impact concerns were not addressed. So, there was a ban on proceeding with the project, and the construction got delayed by several years, causing huge financial loss for this company. So these are the kind of things that happens when you are not taking ESG into appropriate consideration. Moving to, say, Africa, in Eastern Africa, PwC, the professional services firm, did a research which revealed that investors are pulling out from companies where ESG matters are not getting serious attention, which is a fact. And in many countries, we see similar situation that investors or the capital providers are seriously looking into the ESG quotient of any business. In Australia, there was a reputational risk or reputational issue happened with the large mining company Rio Tinto. They did some mining activities in a sensitive geographics, which caused community outrage. So much so that the company actually apologized in their own web page, and this is recorded in their sustainability report. So there are numerous such examples of risk that businesses face in case of not taking cognitions of ESG or sustainability related matters. Let us move forward. Yeah. This illustration, as you see, shows a typical progress of implementation of ESG strategy by an organization. And as we have seen over decades across organization, typically how it happens is at the initiation phase, which you see on the left bottom, as the need emerges, companies first try to address compliance to regulations. That helps in managing risk from penalty or closure and things like that. And at this stage, also the basic initiatives are taken on material or energy efficiency, safety, corporate social responsibility, and so on. When the initial building blocks are established, organization, if you move to the second phase, where organizations move towards materiality analysis, understanding which are the key ESG related topics, they apply what you call 80-20 principle, so to say, to find those 20% ESG topics, those matter 80%, where the initiatives will really be kind of fruitful. Further maturity, move along to the third phase, the mature organizations, where the company takes to do benchmarking against peers or leading practices, explore new areas, say climate risk, its implications, and so on and so forth. Finally, a matured organization tends to embed sustainability across its business functions, which not only mitigates the risk, but also starts, kind of leveraging on the opportunities. If you see the lower part of the diagram, the transition happens from, initially to compliance and risk management to managing for value, and then towards a strategic leveraging on strategic advantages for an organization through ESG. So that is how typically the maturity happens. And in all these stages, you require actually, a proper walked out steps, which I would hand over to my colleague Tarini now to tell us more about how, this kind of planning and other things are done. Over to you, Tarini.
Thank you, Dipankar. So a very warm welcome to everyone. And as Dipankar has helped set the context for today's discussion, I'm Tarini Sahu. I'm joining you from Mumbai, India. And so just to take the point forward, to The point of any reporting entity, for any entity that is involved in demonstrating how well they can highlight ESG related performances, meaning that, in other words, how can organizations basically highlight uh, just there is some message coming onto the screen. If Meha, if you can address that in the chat. So the point is to operationalize ESG strategy. And as Dipankar had already highlighted, that on the double materiality aspect, on the materiality for environment, social, and governance factors for an organization, this was already carried out, shared with you on the webinar 2. Some of the recordings might already be available, and I hope you can get your hands on this. We would strongly encourage you to actually take a look at that. Of output of the materiality, once the organization has identified what is material in terms of uh, the environment, social, and governance topics, the organization then needs to first understand what is the level of alignment that you have, that it has with respect to its functional teams and the departmental teams that they have. What is the level of alignment that each of the functional uh, dimensions in an organization have with respect to the identified material topics? And once we, and this we are able to achieve, realize through interactions, one-on-one interactions and very targeted interactions with the different departments, be able to then understand that, be it a human resource department or a finance department or a procurement department and such, what is the level of integration or how well embedded are the ESG identified ESG topics within their respective functions. A subsequent step of follow up of that would be that once we have identified what are the gaps or what is the current state in terms of the functional alignment, we are then able to also look at what is the kind of ESG landscape that an organization holds. And by that we mean what are the levels of systems and procedures, what is the level of alignment that they have. There might be certain policies that are that need to be developed, drafted, or amended with respect to the topics that have been identified material for the organization. They might also have there might also be a need for the organization to integrate the identified risks within their respective enterprise risk management framework in order for them to actually ensure periodic review and management of mitigating steps against the said risks. The organizations also need to take into account that basis the identified ESG related risks, there have to be sustainability related goals, targets, and key performance indicators identified. Because all of these steps together would ensure how well an organization has a very structured manner in which they are not only understanding which are the issues that are pertinent to their nature of business, but also how timely, what is the timely response that they can mobilize in order to mitigate or remediate any kind of risk measures. Ultimately, what you see on the right extreme of your screen is that the organization, therefore, summarizing all of the previous steps, are able to consolidate what would constitute a sustainability framework, wherein the ESG integrated culture is what actually comes out. And there are four facets that we have shown here. It starts with organizational policies and systems, which leads into operational engagement between the different functional teams, as we mentioned. It also ensures a level of monitoring, reporting, and improvement, a continual improvement. In ISO terminology, the plan, do, check, act, as we say, that is being embedded within the organizational culture. Ultimately, all of these feed into the company or the organizational level strategy, and these formulate or these comprise the risk drivers, and the organization has better visibility of what is pertinent to them in terms of ESG related risks. You can move to the next one, please. Here is an example. It is just a quick snapshot of the sequenced steps that Dipankar was referring to, where, as we we saw in the previous slide that there are going to be functional teams that we need to actually have discussions with. Targeted discussions with these different functional teams in an organization help to identify what are the gaps relating to how well these are prioritized, these risks are prioritized within different functional teams. What is the extent to executing these kind of ESG embedded functions that you have? What is the level of integration? By that we mean that be it any respective function, how well ESG is referred to in making their decisions, in executing their respective function, and ultimately for an organization, does ESG only constitute the responsibility, or is it the role of only one sustainability team or a HSE team? So that's where it inspires the notion of having a cross-functional accountability for implementation of ESG strategy at an organization. What you see on the center of your screen is just is a visual which basically summarizes that the outer periphery of the radar map for every functional team. We then look at what are the leading peers for we might be conducting a ESG strategy project for a mining firm. Now we look at what are the leading peers, what are they doing in terms of with respect to that particular functional team. So it could be, as on the screen as you can see, that they might be that okay, there are governance practices, there might be strategic practices, there might be the finance team hasn't embedded it enough, so therefore you are able to see the inner quadrant is particularly for the current state of the organization, and the outer periphery is that of the leading peers. And therefore, we have a current state assessment carried out, which basically gives us a delta or a gap assessment between what a particular functional team, a HR human resource function at the reporting entity, how it fares against its leading peers. And this is where we do this kind of assessment for all the different functional teams. That is how, if you draw your attention to the right of your screen, for every functional team, we outline a particular gap assessment, uh, the types of gaps that exist between the company and that of their peers. And therefore, we always highlight or draw a line of caution for our clients that it is not a competition. This is not a score matrix where the strategy team has to compete with the human resource team or such. It is always a benchmarking exercise where the organization understands its respective functions. How do they fare against the respective functions of their leading peers? We then are able to outline a function-wise roadmap. Essentially, it could be a 3-year roadmap or a 5-year roadmap, and the roadmap basically highlight the company's goals and targets with respect to environmental initiatives, social adherences, and governance practices. All of this feed into, we saw in the previous slide, the need for continuous improvement and monitoring. And that's where we always encourage our clients to conduct a re-evaluation of the gap assessment that I just detailed out. It could be at the start of a engagement period with a base year, and you have identified an end year. Say if you have an execution period of 3 to 5 years for every roadmap, you can always have a base year evaluation and an end year evaluation. There might also be change in business settings. For any organization, there might be mergers and acquisitions. There might be change in the expectations of different stakeholders. And that's where it is always pertinent, prudent for the organization to conduct this re-evaluation. There might also be emerging disclosures that are coming up. A lot of geographies or jurisdictions actually see then there is a heightened stage of disclosures, ESG related disclosures that are actually coming up. And you can very well now imagine that if you imagine a continual loop feedback mechanism that actually happens in this, every 3 to 5 years, the organization can undertake these activities, and this entire exercise would then feed into the subsequent steps which help refine the state of readiness for an organization in demonstrating its ESG readiness. can move to the next one, please. A very critical but apt concept that most organizations have taken to is the concept of value creation, wherein the organization in earlier periods would concentrate more on the financial materiality of the organization. In what you see on your screen is the need for an organization to generate value, identify what are the who are these key stakeholders. On the bottom of your screen, you are able to, we have highlighted some of the key stakeholders. It could be governmental or regulatory authorities, communities and consumers, investors, shareholders, the board members, employees, suppliers, and vendors. So these are a diverse group of internal and external stakeholders that an organization takes into account in ensuring how it aligns its business output to its expectations of its stakeholders. And therefore, it is pertinent that the organization also understand how ESG, embedding ESG within its nature of business, would create value for its respective stakeholders. And in doing so, you are able to, if you draw your attention to the four main blocks that we have in sequence, they first, there has to be some level of appreciation or understanding of what constitutes ESG for the business. That feeds into what is what are the strategic developments that you will have to identify. And as I was mentioning in the previous previous displays, that there has to be some level of benchmarking exercise that basically identify what your leading peers are doing. What is the sectoral mandate for this? Are there any regional and global mandates for the type of industry that you represent? This kind of gap analysis ensures that you are able to identify what needs to be done for the organization, and therefore it identifies also the scope for the implementation for such. Drawing your attention to the third quadrant that you see, the third segment primarily focuses on if an organization were to have identified the gaps, and therefore for the for the said gaps, if they were to implement or carry out any mitigating or remedial kind of action, there has to be some level of awareness mobilization. There has to be some level of capacity building that has to be done. The selection of the appropriate ESG initiatives. What are the types of process related and product related actions that an organization needs to mobilize? And ultimately, what are the non-financial reporting practices that the organization needs to heighten? And it goes without saying that in order for the organization to also ensure that there is no greenwashing done, to improve the confidence, to heighten the confidence of the stakeholders in the information or the disclosures that the organization puts out, there has to be assurance or verification of the information that the organization is setting out. And ultimately, what is, if you draw your attention to the fourth segment, the need for monitoring and evaluation as the final segment, which will ensure that the review of integration and implementation across these segments happen in a more timely and robust and effective manner. If you draw your attention to the bottom of your screen, the right bottom, you're able to then see that it highlights the need for a capital accounting approach. Environment, social, and governance aspects can be very easily summarized into 6 capitals that go into the integrated reporting framework. They include the natural capital, the manufacturing, human capital, the social and relationship capital, the finance capital, and the intellectual capital. And all of this capital accounting approach is a very structured approach, which is sector agnostic, and it cuts across any kind of industry that you have. So in order for the organization or the entity to ensure that there is appropriate number of adequate value creation quotient available with them, they need to mobilize a capital accounting approach across the different types of stakeholders that they involve in. We can move to the next one, Meha. Coming to how do we now the organization, if an organization were to actually mobilize ESG strategy, what are the levers that they would like to mobilize? What is on your screen is there are multiple strategies that an organization can actually employ. One is the ESG strategy, where we are looking at a sustainability strategy that reflects the company and the board's vision around ESG. The board, the employees, the stakeholders, internal stakeholders might already have a vision for the organization to demonstrate their leadership position in terms of responsible business practices, and therefore the need for an ESG strategy comes into play. A lot of organizations which are emission and energy intensive might already be looking at adopting a net zero strategy, where they develop a emissions reduction strategy which include deploying net zero targets. Net zero is becoming a currency of common discussions, and therefore organizations heighten their investors and stakeholder confidence when they already are able to demonstrate that they are ready for the future. They are future ready in terms of how their businesses are going to be viable for the future. Coming to the reporting strategy, organizations companies are very keen to actually understand what are their stakeholder requirements. There are multiple regulatory mandates that require organizations to take into account what needs to be disclosed, how transparent should be their disclosures, what is the level of the comprehensive reporting that the organization needs to do, what is the level of um, disclosures that the organization needs to bring out with respect to its not only its direct operations but that of its indirect operations. That means their vendors and the suppliers and such. So the mandate for reporting strategy in an organization is very, very critical to, and it has a significant bearing on how the stakeholders view the organization. On sustainability reporting with feeding into ESG ratings, this is a very obvious implication, where rating platforms like Dow Jones Sustainability Index or Morgan Stanley Corporation International, all of these actually rank organizations on the scale of how transparently reporting entity is able to demonstrate its performance with respect to environment, social, and governance parameters. And comparability of these performances are brought forward with ESG rating platforms like the ones I just mentioned. Ultimately, once an organization is able to consolidate what constitutes environment, social, and governance performance, there is a very urgent need to for dissemination of the said information, and that is exactly where we see that it is this is the communication of ESG communication across an organization is a very compelling signature of progressive organizations moving ahead in their not only embarking on their ESG journey, but moving ahead with this mandate ahead. All of this very clearly has an impact on share price. And we have a few examples in the subsequent slides where we will show you how these aspects have a direct and telling impact on the share price of a particular organization, which basically is an indicator of investor confidence and the customer trust in the brand that the organization represents. Can move to the next one, please. Here is an example of how ESG strategy can create value. Now, ESG or adherences to environmental compliance, social and governance good practices and best practices can always ensure reduction in costs, and they also generate new revenue streams. They're able to enhance the organization's productivity and also open opportunities or windows for greater access to finance. MSCI study summarizes, this is a snapshot of the particular study, where you're able to then see that based on the current value, if there are organizations that have taken into embedding resource efficiency, labor productivity, tax benefits, compliance, new revenue streams, better reputation, and several such aspects or the dimensions for ESG strategy, which have added and demonstrated improved value. And all of this collection, this is the sum of the parts, is what you see onto the right of your screen, where the improved value in terms of the share price, in terms of the market positioning, is demonstrated across different sectors. We have some examples to show in the subsequent slides. Meha, we can move to the next, please. Here is so how can organizations create value through by deploying ESG strategy? The direct impact for business to business and business to consumer uh, uh, lines of organization, they, along with their sustainable products, are able to gain better access to resources through stronger community and government relations. They're able to add to the top line growth. There are cost reductions that the organizations are able to realize through low energy consumption, improved efficiency in their operational output, the reduction in resource, be it with water or raw materials, and also they are able to then reduce the costs associated with improved waste management output from their operations. Regulatory and legal interventions are also brought to good light, where the organizations are able to secure subsidies and government support for their business output. On the productivity uplift, a very critical aspect dimension of any organization is its human capital, and that's where once an organization is able to deploy a very robust or strong ESG strategy, they're able to inspire or boost an employee motivation. They're able to attract and retain greater talent within the organization, which adds to the human capital and the intellectual capital of an organization. Onto the right of your screen are some of the examples that we felt we could highlight for you. Safaricom, the telecom operator, we are able to then see that they set their target to become net zero by 2050. And also and this was on the environmental front. On the social front, they were able to instate a 50-50% gender parity at senior management. Similarly, at Harmony Gold Mines, they were able to instate the role of the ESG governance with respect to how they monitored ESG risks and opportunities for the organization. The KCB Bank, Kenyan Bank, they developed climate risk management systems and measures for sustainable supply chain. Similarly, you are able to then see other organizations which have ensured not only initiatives on environment, but also on governance practices, leading governance practices in their respective sectors. All of this are basically able to generate value for the company. They're able to inspire trust in the customers. They're able to inspire confidence in the investors, providing for greater and seamless access to capital. Can move to the next one, please. Here's one example on the left of your screen. If you were able to, our apologies if the print is too fine for you. In any case, this presentation, I'm sure, will be available for you to take a look at it more keenly if you, as you have time. On the left of your screen, this is a MSCI report from 2020, which basically then highlights what is that among the different parameters that you have, carbon emissions, you have water stress, what are the labor management and other practices. Cutting carbon emissions yielded the biggest financial benefit. Now, the study basically takes into account that of multiple initiatives that an organization can take into account, that there are some which are actually which offer a competitive advantage with respect to the type of business that you are in. And you can very well imagine that investors would like to actually see where they get the bang for buck for their investment portfolio. It attracts investors and lenders to such a level where the said stakeholders are very wary about what are the types of ESG risks and opportunities in their investment decision making. Um, it also builds customer loyalty, as I was mentioning to you, that the trust the customers have, they basically are, the customers are much more aware compared to previous periods, where now access to information is more seamlessly available. And that's where organizations need to actually step up their performance so as to ensure that they are in track for ensuring responsible business practices. We can move to the next one, please. Here is an example, and it's a very interesting example. And this is a real world example that the Video India team has had. Um, uh, Without taking the name of the organization, this is an organization which identified uh, what are the gaps. We conducted the ESG strategy and gap assessment, and then we identified that the scores that you see are based on the evaluation of the Dow Jones Sustainability Index. And that's where the organization clearly showed that uh, there were gaps in the organization to actually cover with respect to the industry mean as well as that with the industry best. And while you see here the dotted sphere, the dotted section that we have highlighted, that under in environment aspects, they were found to be actually lacking behind the industry mean. Once we conducted this exercise and then identified what needs to basically, where are they uh, faring behind the benchmarked leading peers, and once they started to mobilize certain actions against that, the subsequent years, the same for the same dimension on the environment dimensions, you can see a change in the reporting or in the performance ratings that the organization has received. So this is just one example we are giving you, where this kind of exercise on conducting a ESG strategy and roadmap exercise would help the organization to understand what are the leading practices, because platforms like Dow Jones Sustainability Index, they conduct peer level assessments, and this is exactly where our methodology, videos methodology on ESG strategy is heavily hinged on. Yeah, we can move to the next, please. Here are some case examples where we have seen that we've taken the example of Harmony Gold Mines, Unilever, Exelon, where you can, and for, as you see, that in mobilizing actions on reduction in total carbon emissions, in ensuring enhanced safety measures, or mobilizing skill development programs, the organization was able to then realize impacts which resulted in the revenue increase, which resulted in the investor confidence that they had. A very good example has been with Unilever, where they have ensured environmental footprint. They have an excellent climate strategy in place, which ensured that its share price increased steadily over the years, reflecting that the market and the market players, all the investor uh, scrutiny was well placed, and they were very confident of the way the organization was going ahead with its sustainable business practices, and that resulted in the market positioning for them. We can move to the next one, please. Safaricom, Ebel, and Patagonia are some of the other examples that we would like to highlight here, where they had mobilized social impact projects, uh, where where even access to capital also was enabled on account of this. The focus on environmental sustainability, particularly in terms of Safaricom, through its social initiatives, impacted heavily with the customer's preference for the particular brand, and which resulted in the market returns that the organization has seen in terms of Patagonia, where which the organization itself is very well known for utilizing recycled and organic material in its products, and that exactly has prompted or motivated a very loyal customer base that values the company's principles in the type of products that it comes out with. So these are some of the examples how organizations have identified what should constitute ESG, the focal point for ESG initiatives for them, and how they have mobilized it through their strategy and mobilize it across a different time horizon, and that has inspired, that has resulted in the outputs and the impacts that the organization has seen. I would pause here. If there are any question, or Meha, can we just move to the next? Yes, I think so. I am to the end of my presentation. I'll pause here. If you have any questions, please, I would request if Meha, if anything from the chat, if you would like us to address, else we will make it a point to actually address to each and every one of your queries post this session. Thank you.
Yes, thank you, everyone. Thank you to all our speakers for your insightful presentations and to everyone who joined us today. We hope you found this session valuable and that you now have a clearer understanding of how to create and implement an effective ESG roadmap. And now I'd like to start off with the Q&A session. We have one question from James Moses. He asks, what is the difference between reporting strategy and sustainability strategy? Is there any link?
Tarini, you want to go ahead?
Sure. Sure. So broadly, the reason why we also called out these two in exclusion, that on a reporting strategy is something that reporting is but an output of a ESG strategy when an organization has. On a sustainability strategy, we are talking about, has the organization taken into account what are the environmental imperatives for the organization basis the nature of products that it produces, the types of raw materials that they use, the type of labor practices that they employ if they are a labor intensive organization. So we are saying that sustainability basically cuts across. It is a more overarching kind of theme for an organization to look, and reporting strategies particularly just focusing on the disclosures, on how transparently they can come out with their disclosures. What are the types of stakeholders that you need to address? If you have a lot of CSR projects, corporate social responsibility projects, it only makes sense for you to come out with impact assessments of the type of projects that you have. If your products have a bearing on the consumption of environmental or raw materials, on the resource consumption, it is only pertinent that you have a lot of those disclosures out in your respective sustainability report or your ESG report. I'll just pause here. Dipankar, if you want to add anything further on this.
No, I think that's quite clearly explained. I would just add that, your sustainability strategy or ESG strategy is the overall, plan for action around ESG or sustainability, and reporting strategy or disclosure strategy can actually be a subset of that. So it is a part of overall sustainability or ESG strategy, but it covers, the disclosure strategy or reporting strategy would cover only aspects related to your disclosure imperatives.
Thank you for those insights. We have a few more questions. If we have time, just let me know if we're good to go for a few more questions. Okay.
Sure.
So the first question is, does having an ESG strategy and implementation help the customers in a country like Kenya, Uganda, or Tanzania in East Africa to encourage people to pay more for the company's products? Does the consumer really care, or do they look for the lowest prices these days?
I think I can start and then maybe Zahir can give certain local examples. And as we have actually seen that generally, the customers or your business associates are increasingly becoming aware on ESG related matters, and people are ready to pay higher price for your products, so long it is kind of rational and justified. For example, in many countries, we have examples of what you call star-rated electrical appliances, which are having higher efficiency than the normal. Say something like 5-star air conditioner is better, more efficient than a 3-star air conditioner, and usually the prices are high. But customers today are actually going for those. There's a high demand of such, responsible products, which eventually in the longer run is kind of benefiting the customers in terms of energy bill and so on and so forth. So that's just one example, but maybe Zahir, some local examples from your quick recall.
Sure. Yeah, Dipankar, you're right. Can you hear me?
Yeah, we can hear you.
Right. So yeah, you're right. I mean, in East Africa, this solar power, okay, is a big thing. So, a lot of people in their businesses, okay, are reducing their electricity costs, okay, through the installation of solar panels. A lot of businesses are using, for example, low power bulbs. Electricity is very expensive in East Africa, especially in Kenya, for example. Our tariffs are very high. And if you invest, okay, in energy saving bulbs, for example, you can reduce your energy bills, okay, by 70%. So, but of course, the LED bulbs, for example, are much more expensive than just a normal bulb. But this is how businesses are going. So you find more and more businesses, you'll find more and more consumers as well looking for products that are green, because they make economic sense as well. So definitely, we're no exception. Of course, where there's more poverty, then there's going to be that price sensitivity, and some people may still want to go for the cheapest product. Okay, but overall, businesses, even in East Africa, can see the sense, okay, in going green, and then having a very strong ESG strategy in place because it makes sense for their businesses.
Okay, thank you. We have one more question from James Moses. Thank you for your question. The question is, so sustainability is more broader than reporting strategy. So as a beginner, is it better to start from reporting or the sustainability strategy?
That's a very interesting question. And, maybe I will start and then others can perhaps add. I have seen, practical examples, many organizations in not only in regions of India or regions of Middle East, North Africa or Europe, across the regions, we have seen that many organizations started with some strategy on reporting or initiatives on reporting. And then once they have got some benefits out of it, they have started, going for overall ESG strategy and other things, which apparently looks a little counterintuitive, but that is what has happened, in the past years. But I think those organizations which are starting now, guided by the more stakeholders kind of expectations, requirements, and regulatory requirements, are actually doing it in the, I would say, the normal expected sequential manner, which is, having an ESG strategy first and then going one step ahead for disclosure related initiatives and strategy. So it's very, I mean, your question was very interesting, and we have seen both kinds of things in the past.
Okay, thank you, Dipankar. And we have one last question. The question is ESG applicable to insurance companies? How is it applicable? And what are the associated costs? Do you have any insurance company as an example in East Africa?
Tarini, we might not have an example from East Africa at the moment,
No.
but Zahir may add on that. But in general, financial services, we can share some examples, including insurance,
Yes.
right? Yeah.
Yes. From a few, I would like to dip into some of our recent conversations with certain insurance companies here in India, where there is a very heightened sense of alignment with the climate risk assessment, particularly because as an insurance provider. In India, there are the regulatory authorities, the regulatory bodies for IRDAI, which is the regulatory authority for the insurance industry. They have basically ensured now that there has to be some level of updates for the senior management at the insurance company for the ESG related updates within their boards. But more specifically, for a practical purpose, for any insurance company, they need to be aware about the companies that they provide insurance for. What is the level of vulnerability that they actually have access to? What are the types of mitigation that they have? Because that has a direct implication on what is the capital expenses that the insurance company would have to. The level of insurability for certain assets are also called into action, and a lot of asset valuations are a direct output of how vulnerable a particular asset is in certain locations over others. And so all of these have very direct dependencies on how insurance companies are viewing the borrowers, and in this case, the insured companies as well. So this is not only limited to the climate risks, but also on companies which have heavy bearing on the labor force. Now, if the companies are not compliant with the regulations on that, the insurance companies are actually very wary on that. Who are the ones who are getting insured? Are they compliant with the different norms, not only of globally accepted practices, but also of regional mandates that are applicable?
Okay, thank you for that insight. We have a few more questions coming in, and thank you all for participating. I think if we have time just to take the one last question before we wrap up. So this one is specific about ESG. It's asking, should we not separate E from S and from G in the ESG concept, as G, or governance, is a given and should be a need, and that it's the S that people should talk more about and are confused about? E, environmental, is known on inputs, etc. Being socially responsible is vital.
I think there has been quite a lot of discussion on this, and out of E, S, and G, what is more important. And as we had seen in some of the slides which we presented in this, as well as the previous ones, that governance is something which is, the bedrock on which, the pillars of sustainability, components of economic sustainability, social and environmental kind of, stand, and it is supported by through strong governance. So I think whether governance is more important, or the environmental, economic, or social parameters are more important, I think it's a kind of a bit of a theoretical discussion. All are important, to be very frank, because they supported. It is supported. All the environmental, social parameters are supported by a good governance of any organization. Tarini, you wanted to add anything else?
No, this is you're rightly mentioned that the governance, while we use the terminology on E, S, and G, it basically, if you look at frameworks like the Global Reporting Initiative, the environment, economic, and the social are the main pillars. And governance basically is the underlying mechanism in which implementation against the three pillars in collective would actually enhance the ESG strategy for, or the sustainability strategy for an organization. So that with that I'll pause.
Okay, that's all the questions we have today. And thank you once again for joining us. We had a good turnout, over 75 people, which is great. And we hope that you all show up for the next webinar. We'll confirm the date, but most probably 24th July. We'll still confirm that. And of course, thanks to our panelists, Dr. Tarini Sahu, Dipankar Ghosh, and Zahir Sheikh. Thanks to BDO India for collaborating with us and for this very insightful presentation. We really thank you. And yes, that's all from us today. Hope to see you all at the end of the month. Thank you.
Bye, everyone.
Thank you. Bye.